Hello, everyone, and welcome to this special edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. In today's special episode, I've asked a couple of our fellow StockCharts contributors to share their favorite indicator, and I tried to keep it pretty open-ended. Did not give them any particular guidelines or specifics, just said, how would you answer this question? What is your favorite indicator? We have two fantastic contributors that are going to answer. I will answer that question as well. Grayson Roze, VP of Operations here at StockCharts.com, host of Stock Charts in Focus, is going to share with you how he uses relative strength. And had Grayson not picked relative strength, I would have done it, because relative strength, looking at a stock versus a group of stocks, right? A stock versus a benchmark or an ETF, looking at what particular price series you're analyzing versus all the other things you can consider, super valuable. Erin Swenlin took it a little different direction. She actually is going to talk about her Golden Cross Index, which her and her father, Carl Swenlin, created. The Golden Cross and Silver Cross Indexes as a measure of market breadth. Really timely and interesting to break down the markets using that particular tool in this environment. I'm going to come back at the end here in a little while and share with you one of the indicators I find incredibly helpful, the MACD indicator. But let's start with Erin Swenlin.
Hello, my name is Erin Swenlin from DecisionPoint.com, and I am here to tell you about my favorite indicator. Now, a lot of you know that I am certainly at Decision Point enamored of my PMO, my price momentum oscillator. However, I'm going to take a left turn here, and I'm not going to do the PMO. It is my favorite indicator, but there's so much information, and I talk about it all the time. So I wanted to bring something new to the table. So I am bringing my Silver Cross Index as my favorite indicator. It also has a partner called the Golden Cross Index, but we're going to concentrate mostly on the Silver Cross Index today. So let me take you in and explain a little bit about what the Silver Cross Index does, and then we can dive right in. So a golden cross, if you're familiar, most of you might be, is considered a 50-day EMA cross above the 200-day EMA, or the simple moving average, whichever one you use. But a 50, 200-day EMA crossover is considered a golden cross. Well, when we came up with our Silver Cross Index, we decided to call a 50-day crossover a silver cross. And I'm going to explain why we're doing this. So when the 20-day EMA crosses above the 50-day EMA, it's a silver cross. So Golden Cross 50, 200, Silver Cross 20, 50. And then what we do for these indexes, it's an index. So that means you're taking a group of things and then turning it into an index indicator. And so what we do is we tally up the percent of stocks that are on a golden or a silver cross. So you're not just looking at price above the 20, price above the 50. You're actually seeing the stocks that are already configured to do well. And by doing that, we can start measuring the market bias and participation. So with market bias, basically, we look at the price above their 20, 50, and 200. So that's the one you may already be familiar with. You might have already seen that in some of our charts. And then what we do is we compare how many stocks are above their 20, 50, and 200 to what the silver and golden cross are telling us. So if you've got participation being lower, meaning you have, let's say, 20% above their 20-day EMA and 20% above their 50-day EMA. Well, if the Silver Cross Index is going to be moving upward, then you're going to need that participation of stocks above their 20 and 50 to go up, because you have to have a way to bring that 20-day EMA up for that crossover. So if you have participation lower, as I was just talking about, it's a bearish bias. If participation is greater or equal to, is lower. If participation is higher, then that means you're going to have a bullish bias. So if there are more stocks above their 20 and 50 EMA, then there are stocks with a silver cross with a 20 above the 50, then that means you've got a bullish bias. So let's look at it on a chart, but I'm actually going to get you to the chart that is for the day we are recording here. And that way you can get the most up-to-date information. Plus, I have it set up so that it takes up the whole screen. All right, so what are we looking at on this chart? So here is the Silver Cross Index and its signal line, which is a 10-day moving average. And then we have the Golden Cross Index with its 10-day moving average as its signal line. And then here is that participation I was talking about: stocks above their 20, stocks above their 50, and stocks above their 200 EMA. And so you can see right now in the market, and we're finding a lot of interesting information about this Silver Cross Index, but just looking at what the bias is currently, it's clearly bearish, right? We have far less stocks above their 20 and 50-day EMAs than we have silver crosses. So if you don't have enough stocks above their 20 and 50, if they are below their 20 and 50, well, that is going to drag that 20-day EMA down below the 50-day EMA. So that means you have a bearish bias. But the other thing that we look at with a silver cross are divergences, and really the height of where it is turned over. So back here, you can see that we had a negative divergence in the intermediate term. So this Silver Cross Index was seeing lower highs, but price was seeing higher highs. So that told us that we should expect a decline coming up. And sure enough, that's what we ended up getting here. But then we had a longer term negative divergence between this top and this top. And price was, again, still rising. And so when you see a longer term negative divergence, you should expect a longer term decline. And sure enough, that is what we saw. Now, one of the things on this chart, I think that makes it helpful so you can see how great this indicator is that we mark vertical lines on what we call cardinal tops, primary tops. And then we use a green vertical line to mark cardinal bottoms or major bottoms in the market. So you can see what the Silver Cross did during that time. And typically it's going to get you in a little bit late, it lags just a little bit, but it still moves faster than some of the other indicators, which may have kept you, which may get you in too early. So this is a really nice indicator. The crossovers are great, but I also like to look at when the PMO, see, I love my PMO. When my Silver Cross Index starts to bottom like this, that's a really important place to watch. So you can see back here, we had some bottoms come in right in this market area right here. See that little bottom right there? And that matches up almost perfectly with this price bottom. So this indicator is super powerful. The other thing that we look at is the actual numbers on the Silver Cross Index. And this is what's telling us that currently the market's in a really precarious place. I'm not going to say that, I mean, we're very bearish right now. I'll tell you that right now. But this is, of course, recorded for later viewing. But we're very bearish because we have these very negative, we have negative divergences going on here. And that is higher price tops, lower tops on the Silver Cross Index. So that tells us that we should start expecting some kind of a decline, because that's what usually happens when we get the Silver Cross Index topping, and certainly when we have negative divergences. But here's the other problem we have. Looking at just the number of stocks anyway, you've got almost 80% were at this top. And at this top, this area, we only had about 60%, 55, 60% with silver crosses. That is seriously not good participation. That tells you that only certain stocks are leading the market, which Right now, all of the mega caps are really keeping the market propped up. So that is really a great indication to tell you that there is no place for leadership after. So that's all I have for you today. Again, my name, Erin Swenlin from DecisionPoint.com. Good luck and good trading.
Hello, everyone. Grayson Roze here with StockCharts.com. And coming to you today, we are going to talk about my favorite technical indicator. The team asked me to come share a little bit about my own process, share a little bit about my own charting, and I'm excited to do that with you today. Now, my favorite technical indicator is one that a lot of other technicians use. Price relative strength goes by a couple of different names. But as you're going to see today, relative strength takes whatever symbol you're charting and compares it against a benchmark. This is the most important technical indicator on my charts other than price itself. Now, I'm going to let you in on a little secret about me. I like to be lazy. I think I'm a hardworking guy overall, but when it comes to my charting, when it comes to my investing, I actually like to be lazy. Now, we can take something like SPY, VTI, some of those market tracking ETFs. We can go out and buy those these days and just let them run for years on end. We know that those are going to compound at about 8, 10, 12%. And I can do the math. I know that compounding at 10% every year over a long period of time is going to do a lot for my portfolio. So if I'm going to go out and take the risk of buying something other than SPY or VTI or SPTM, any of those market tracking ETFs, I got to know that it's worth taking that risk. I got to find something that's outperforming the market, because if it's going to underperform that 10% that I'm going to get on an annualized basis out of something like SPY, why own it? If it's not outperforming the market, why do I want to own that thing? I might as well just go buy the market tracking ETF. So the tool that I use on my charts to help me make sure that I'm in things that are outperforming the market is relative strength. So let's jump over to the charts and take a look at how this looks on my own screen. All right, everyone. So we are here in ACP. This is our advanced charting platform. And the really, really cool thing about ACP is that it gives you kind of dynamic controls over your charts. We can actually zoom in and out through time pretty dynamically. Now, I want to give you kind of a flash to what my charts sometimes look like, what my charts used to look like. I want to tell you how important relative strength is to my approach. It's this panel up at the very top, as you can see, NVIDIA in this case versus VTI, the total stock market. We're going to dig into that in just a second. But my charts used to look something like this. This used to be my default chart. Now, I actually have 3 different views of relative strength up at the top. In this case, we're comparing the stock versus the market, the sector versus the market, the industry group versus the sector. So I still have always had those relative strength views up top, but I had a whole bunch of other indicators on here as well. I still use these charts from time to time, but over the years, I've actually slimmed down. As you can see over here on the left side of ACP, I have what I call kind of a chart leveling system. So I actually start at a very, very simple chart, just the price bars and a couple of moving averages. I then bring in relative strength and volume. This is actually my default chart. You can see it's got that little star right there. Then I bring in some additional indicators like RSI, and then bring in even more like accumulation distribution and the scooter, finally getting up to that level 4 chart that we just showed. The reason that I'm showing you this is that this is kind of the most complex chart that I ever look at. It's got these sort of 4 different indicators down at the bottom. It's got a bunch of things on the price bars, and it's got a couple of different relative strength views up top. Over time, though, I have cleaned up my approach. I have stripped things out. I still have access to this view, but I've really narrowed down to a focus on just price itself and relative strength. I still do have some key moving averages on there, price extensions, and I still do have volume. But as you can see, the chart that I like to look at, the default for me is this very, very clean view with just the price bars and relative strength up top. So the way that you can actually add this to your charts, to give you a quick sense of it, you can come over here to the Add Indicator menu. You can do this in Sharp Charts as well, and type in price. Now, in the Standard Indicators section, you can see that you've got a couple of different options. If you want to use the price, just sort of standard indicator, you can do that. I like to use price performance, though. Now, what price performance is going to do is going to put that indicator into percentage terms. So you can see up here in this top panel, We're actually looking at how NVIDIA has performed over this period of time relative to the total stock market. And we're looking at that in percentage terms. We can see that over the last, let's make sure we're on 1.5 years, which is kind of my default time frame. Over the last 1.5 years, NVIDIA has outperformed the market by 35%. So I like that performance scale because it makes things kind of directly comparable across symbols. To get there, I like to use that price performance indicator. Now, the way that we set this up in StockCharts, we go to that symbol box, we type in $symbol : VTI, or whatever your benchmark is. Let's pause here for a quick sec and talk about ratio symbols. On StockCharts, if you want to compare two different symbols, you separate them with a colon. So if you want to do Apple versus Microsoft, how has Apple outperformed or underperformed Microsoft, you could do AAPL : MSFT. If we want to create a relative strength line on StockCharts using either that price indicator or, in my case, the price performance indicator to get things as a percentage, what we're going to do is we're going to type in this box, as you can see, $symbol : and then whatever your benchmark is. This is going to chart whatever the main symbol on the chart is against the total market. So if we pull up something like Microsoft, we can see this is actually going to follow along with us. And now we're charting Microsoft versus the total market. Now you can set this benchmark as whatever works for you. If you want SPY, the S&P 500, if you want $SPX, the actual S&P 500 index itself, you can type in any benchmark that works for you. In my personal case, I like to use VTI, which is the Vanguard Total Index. Tracks very, very similarly to SPY, but because it's the total index, still cap weighted, but still the total market index, it does bring in more stock. So in my case, I want to say, is this stock that I'm thinking about buying outperforming the total market, or is it underperforming the total market? Again, that's kind of the question that we're answering here with relative strength. And so in this case, I like to use VTI as my benchmark. So here's how you set that up. We've got our price performance indicator. We've got $symbol : VTI. And again, what that's going to do is give us this relative strength line right up at the top of the chart. Now, again, the key here is this thing that I'm considering outperforming the market or not? Let's actually go back to that NVIDIA example because it's a really, really powerful one. Here we have a stock, especially on today, if I move our crosshairs off the screen there, up 25% on the day, a huge, huge pop. So we can see that NVIDIA, obviously on today alone, has been outperforming the market. But really, since those kind of October lows that we saw last year, NVIDIA from this bottom point has really been outperforming the market. We can see that because this relative strength line is going up. If this line is going up, that means the symbol is outperforming the benchmark. If this line is going down, that means it is underperforming. So we can see here that NVIDIA over the last sort of leading up to those October lows, for quite some time, almost a year, NVIDIA was steadily underperforming the market. If we zoom out a little bit, let's actually look at a 2-year chart here to make this nice and easy to see. We can see that from those kind of November highs, NVIDIA started steadily underperforming the market. Now, it was after actually kind of drifting sideways for most of that time, really just kind of chopping around up near those highs. But for me, when I see a chart that's drifting sideways and still underperforming the market, that's something that I want to steer clear of. If I see a chart that's breaking out, looks good on price alone, but is also underperforming the market, well, even though the price bars look great and the chart is making new highs, if it's underperforming the market, I might as well just go own that ETF like VTI or SPY, whatever it is. So relative strength, price relative, really gives me sort of another filter for analyzing individual charts. I can see a lot more than just the price bars. I can see if things are actually worth owning or not. Now, the other great thing about relative strength is that you can use it just like price bars. You can analyze relative strength in terms of new highs and breakouts and trend, all of that kind of thing. So we can say here, NVIDIA was actually breaking out a couple of weeks ago, kind of earlier this month, was actually breaking out to new highs, not just on price itself, but also on a relative basis against the total market. Those are the kinds of things that I look for when I'm thinking about a trade. I like to find stocks that are breaking out not just on their own sort of price movement, but also on a relative basis against some of those indexes that I track. If I can find a stock that's breaking out to new highs on price alone and breaking out to new highs against the total market. That's kind of a double setup for me. That's what I love to look for in the charts that I am going after. So, relative strength, incredibly easy to add to your charts. An amazing second filter on top of price itself. One that I simply refuse to trade, refuse to invest without. And most importantly, one that also works well over all different time frames. You can think about relative strength not just over the last year or year and a half, but you can think about it on a very short-term basis. If you're trading that short-term kind of time frame, you can think about relative strength over the last couple of days, even the last couple of hours if you're trading that short. If you're going long-term, you can also think about relative strength over many, many years. So if you want to compare how something has done relative to the total market over the last 5 years, 10 years, 20 years, those kinds of long-term trends in the market, relative strength, another great fit there. I've got these relative strength indicator panels on my short-term charts, on my intermediate-term charts, also on my long-term charts as well. So across all different time frames, it is a fantastic, fantastic indicator. That's the reason that you've seen me kind of slim down to those simple charts with just that relative strength panel up at the top. So that is my indicator of choice, relative strength, price relative, whatever you call it, you should still be using it. Thanks for tuning in here on StockCharts TV.
I want to finish off our special episode here talking about an indicator called MACD. The moving average convergence divergence is one of the first technical indicators that I learned. I first learned about price when I was just getting started in the industry. I then learned about moving averages as a way to smooth out the noise of day-to-day price action. Then I was introduced to MACD, which is sort of like okay, if you think moving averages are good, wait till you see what else we can do by looking at trends and rotation and the cyclical nature of markets going up and down. And I was completely hooked. Still to this day, I use the MACD or the related PPO indicator all the time, and I want to share with you how that fits into my process. So here's a chart of Coca-Cola, just showing an example of a sort of a choppier name over the last 12 months to show you how this type of indicator can be very valuable in this particular set of circumstances. So I have the 50 and 200-day moving averages on the chart above, simple moving averages, and then there's the MACD indicator on the bottom. So just to start out with, why do we look at moving averages in the first place? So it comes down to noise. Day-to-day action in the markets is noisy, right? When you look at what happens, there are, and when the market's going higher, you have big up days and big down days. You have smaller move days and bigger days with a wide range. At the end of the day, those fluctuations put quite a lot of stress on our ability to analyze trends. By smoothing out that data with moving averages, we can get rid of the noise, stop focusing on day-to-day movements, and focus more on the overall trends. Now, the most commonly used moving averages are the 50 and 200-day simple averages, and they're so common that I actually use them on pretty much all of my charts because I know so many other investors are using them. But a lot of people look at the crosses between the 50 and 200-day simple moving averages. How valuable are those as a timing tool for a particular stock? I would argue not very good. Now, this is different than what Erin was talking about, which is using them as a measure of breadth, in which case I think they are fantastic for that. She was using exponential versions of this, but I think that looking at that spread can be very valuable for understanding trend and cycle and how many stocks are participating in different moves. But as a timing tool for Coke over the last 12 months, let's look at when the 50-day crossed down through the 200-day simple moving average here in October, pretty much right at the bottom. Then where was that buy signal where the 50-day crossed up through the 200-day? Pretty much right here at the top. And you can see that when a market is choppy, it's actually a really tough way to analyze trends. It actually gives you, in a lot of ways, the complete opposite suggestion that you probably want to hear. This is why Jerry Appel's moving average convergence divergence or MACD indicator is such a drastic improvement. First off, it uses exponential averages, and the MACD line, which is this black line here, is simply the difference between the 12 and 26-day exponential moving averages. So imagine like this was the 12-day EMA, this was the 26-day EMA. Just imagine that's what I'm showing you, and the difference from one to the other, that's what this black line is actually showing you, just the spread between the two in price terms. Then the red line is called the signal line. That's a 9-day moving average of the MACD line. So it's just smoothing it out a little bit further. We simply look at when these two lines are crossing above or below each other. And a little more detail, a little more nuance that I'm suggesting there. For example, the most meaningful buy signal is when the MACD and line gets way below zero and then crosses up. That's sort of the ideal buy signal. You saw one of those in October of last year. Ideal sell signal would be the MACD indicator goes pretty high and then rotates lower below the signal line like we did here in December of last year. So already, look at how the buy signals line up so much better with the turns in the price, the buy signals and the sell signals both. We had a buy signal again here in late January, really early February as we rotated higher, and then another sell signal there in late May. So overall, MACD, not a bad way to make sense of things. Now you'll note, it's not necessarily a leading indicator, right? Going into the low in October, it's still telling you the trend is down. It's not going to give you a signal until the price actually starts to rotate higher. And that's why I think it's a fantastic confirmational indicator. Using an indicator like RSI in complement with something like MACD can be really valuable. And I'll show you that here in a few seconds. So in general, the MACD indicator is designed to help us identify cycles on a chart like Coca-Cola. I think it's fantastic. Here's another name, Starbucks, just to show you more recently some of the signals that we've seen here. Look at how the MACD indicator caught well below zero and then got a buy signal. It's the first real buy signal we've got from this indicator in the last 12 months. Pretty good timing at the end of March. Going into the beginning of April, still pretty positive, about a week in on this big gap down, gives us a sell signal where there's enough of a down move to trigger the rotation lower. And you can see that we got a sell signal there. And at this point, it's still telling us that the trend is lower. So on a chart like this, it's telling us to wait until we would get the MACD line crossing up through the signal line. What's interesting is we're right at the 200-day moving average. We're right at support. And so what I would tell you, just getting back to my previous comment, I think of this as a confirmational indicator. For me, knowing that the price is hitting the 200-day moving average, that's a little more of a leading indicator, anticipating potential support. I also know there's support around this dollar value, around $97 a share, which is right about where we're at, still a little below current level. So I might anticipate support here. The MACD indicator is going to help me confirm if and when support actually holds. So if price does bounce off the 200-day, if we do bounce off of support, the MACD buy signal will give us a good validation that that bottom was actually in play. Now, I mentioned using RSI together with the MACD, so I'm going to add that on here just so you can see how you would use the two of these together. So here we see the MACD indicator. We can see the stock was overbought here in mid-April, which is sort of the red flag early warning system that things might be getting overheated. We then see the MACD line cross down through the signal line going into the end of April. That's our sell signal. Now we're in a downtrend. The RSI is now oversold, telling us potentially we're near a bottoming point or it's gone down a lot. Now we wait for the confirmation, the buy signal from the MACD indicator, which has not happened yet. But if and when that happens, that will tell us that the bottom is most likely in place. What's really cool about an indicator like MACD and others is if you go to our scan engine, you can actually scan for signals. You can scan for stocks that have had that particular signal. So for example, in our defined scans, we have bullish MACD crossovers and bearish MACD crossovers. So embrace the power of a platform like StockCharts to tell you, to help you identify stocks with those types of patterns. Keep your eye on that list for a list of stocks that have been in a downtrend are now starting to turn higher. I hope you found this was a helpful walkthrough. Special thanks to Erin Swenlin of Decision Point, Grayson Roze of StockCharts.com for sharing their favorite indicators. I hope you enjoyed my discussion of the MACD indicator and how that relates to the rest of the StockCharts platform. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll talk to you again soon.